The baseline mechanic of the financial world is a continuous trade-off between risk and potential return. Increasing one requires a corresponding movement in the other. Investors often simplify this relationship into a single, static slider between safe and dangerous, but this linear scale fails. Prioritizing total safety allows inflation to erode buying power, while pursuing maximum returns leads to volatility that triggers panic selling. Successfully navigating between these two extremes requires moving beyond a simple numerical score to a more comprehensive risk profile. This profile provides a clearer picture by measuring three distinct variables: how much risk you can stomach, how you perceive danger in the market, and how much money you can actually afford to lose. Understanding how these three pillars, tolerance, perception, and capacity, interact is the only way to align an investor's internal psychology with their external financial reality. We begin with risk tolerance. This is the precise degree of negative portfolio fluctuation an investor can experience before they feel an immediate emotional urge to exit their positions. Advisors measure this tolerance by looking at objective factors, the hard, quantifiable data points of a person's life. This table identifies those specific metrics. It tracks the client's timescale for investment, their accumulated wealth, family commitments, and their current life stage. While these numbers provide a baseline, tolerance is also determined by subjective factors, such as an individual's psychological makeup and how much they tend to regret past financial decisions. This leads to the second pillar, risk perception. While tolerance measures your limits, perception measures how you view the assets themselves. Perception represents an investor's subjective judgment on the inherent danger of a specific investment. This view is driven heavily by their prior market knowledge and their history with similar products. These two pillars map out the investor's emotional and psychological boundaries. However, these mental frameworks cannot function in isolation without the support of actual capital. This introduces the final pillar, risk capacity. This is the strict mathematical ability to absorb a financial loss without derailing essential life goals. A common danger is a mismatch between these pillars. An investor might have the psychological tolerance of a high-stakes gambler while lacking the financial capacity to survive even a minor market downturn. Capacity is calculated independently of feelings. It is found by evaluating concrete financial objectives, the time remaining until retirement, and the specific mechanics of the investments being considered. Risk capacity functions as a mathematical boundary. It must serve as the final constraint, overriding a client's psychological desire to take on more risk than their bank account can handle. Even when these three pillars are clearly defined, behavioral data shows that humans rarely hold a single, uniform risk attitude across all of their finances at the same time. Investors mentally categorize funds into different pots, carrying entirely different risk profiles. A retirement pot might follow a conservative profile, prioritizing stability for long-term security. Simultaneously, an aggressive profile can be applied to a discretionary pot, accepting higher volatility for greater growth. Because life goals and market conditions change, a risk profile is never permanent. It shifts dynamically based on age, your accumulated level of wealth, and the current economic environment. A healthy financial strategy requires continuously auditing tolerance, perception, and capacity to ensure the portfolio accurately reflects the